That would be nice if we could use some cheaper capital from an operator's perspective. But the challenge that we have right now, which is why you're seeing a lot more of these preferred equity funds coming to the market right now, is that in the current state of the market, if a lot of these sponsors want to refinance a property or put more debt on the property, they're constrained by the DSCR and that loan to value, right? And so a lot of these assets are kind of upside down. And when I say upside down, I'm not saying that they're worth less than what they paid for it or anything like that. What I'm saying is that if the lender is only willing to give you 70% of the loan to value, or say 65 or whatever it is, well, that cost of that capital has actually gone up over the last 18 to 24 months since the Fed has started to do its shenanigans of increasing rates and holding them as high as they have for such a long period of time. And that's causing you to actually come to the table with more money instead of actually getting more money from it.
Hello, and a heartfelt welcome to our listeners tuning in today. Recently, a friend approached me with a question of my economic outlook for 2024. Seeking investment advice in real estate, he referenced an article titled A Pessimist's Guide to 2024. Given this cautious nature, I recommended him considering investments in high yield savings and preferred equity funds. So this brings us to the focus of today's conversation. What exactly is preferred equity and its role in investment strategies? Who better to guide us through this than Dan Handford? Dan is a serial entrepreneur, has established multiple seven-figure businesses, including a successful real estate syndication venture. Notably, he's also ventured into pref equity funds with his latest initiative, the Alliance Fund. Welcome to the show, Dan.
Thanks, Ravi, for having me. Looking forward to it.
Absolutely. Happy to have you. And let's start off with just a basic definition of pref equity. What is pref equity?
So pref equity is just like it says, it's equity that has a preferred position in the capital stack, right? And so if you look at a capital stack and the way, everybody kind of builds capital stacks just a little bit differently, but the way I like to see them visually represented is building a stack. Usually you build a stack from the bottom up. If you think about Legos, you don't build Legos from the top down, you build them from the bottom up. So the bottom, as you're building this stack, the bottom of the stack is usually going to be your lowest risk investment. And that's usually going to be, first off, the debt, the main primary lender on an asset. That's going to be in the lowest position in the capital stack. They also get the lowest return because they have the highest protections and the lowest risk. Well, normally right after that, you have your common equity, and then you have your general partnership equity, right? So that's the people who are putting the project together. They technically have the highest risk. They have to do a lot of work to be able to even get any of the skin that they're going to get at the end of the day in order to get the profits, right? They have to make sure that the debt's paid back. They got to make sure that their common equity investors get their money back plus a certain amount of return before they start getting anything at all. Well, with the preferred equity piece, it's basically saying, hey, as a preferred equity investor or a preferred equity fund, we're going to come in there and insert ourselves right after the debt, but right before the right before the common equity. So we're kind of sandwiched in between the common equity and the debt piece of a capital stack, and basically you're in a very I think it's actually one of the best positions to be in because you're getting a higher return than the debt, but you're also getting a little bit lower return overall projected wise than the common equity, but you're in a very low risk position because if you have a $3 million tranche inside of that pref equity piece, but there's 15 million in equity. There's a lot of equity built up in there that gives you some security and some safety margins there to make sure that you can get your money back. Because that's the biggest problem when you invest is, am I going to get my money back and am I going to get a return? Right. Exactly. And so if this deal falls through and you put in pref equity funds, the debt's going to get paid back first. And then the pref equity provider is going to get paid back their money and their return first, and then the common equity returns and capital return kicks in, right? And so it's a very great position in the capital stack to be for a preferred equity capital investor, if you will.
Yeah, that summary is perfect, and I just want to stress a couple points. The riskier your investment is, the higher the returns. So if you see a deal with crazy high returns, you can assume that it's a riskier deal. There's something that's a little lower, you assume it's a lower risk deal. This is, as you said, is like right in between. So it's like the perfect juxtaposition between these two types of risks. debt and common equity, and you're getting paid, as you mentioned, a bit more because of that than debt. So why would a sponsor want to use pref equity? Why not, why not use more debt? Why not use cheaper capital?
Yeah, so that would be nice if we could use some cheaper capital from an operator's perspective, but the challenge that we have right now, which is why you're seeing a lot more of these preferred equity funds coming to the market right now, is that in the current state of the market, if a lot of these sponsors want to refinance a property or put more debt on the property, they're constrained by the DSCR and that loan to value, right? And so a lot of these assets are kind of upside down. Where when I say upside down, I'm not saying that they're worth less than what they paid for it or anything like that. What I'm saying is that if the lender is only willing to give you 70% of the loan to value, or say 65 or whatever it is, well, that cost of that capital has actually gone up over the last 18 to 24 months since the Fed has started to do its shenanigans of increasing rates and holding them as high as they have for such a long period of time. And that's causing you to actually come to the table with more money instead of actually getting more money from it. Where prior to the Fed doing this, I heard multiple times where sponsors would put a deal together, raise the rents, improve the community, increase the NOI. They'd refinance it and pull out several $1 million, right?
Right.
Well, now it's the opposite of that. You do a refinance and you got to actually infuse capital into it to pay the principal down enough to get the DSCR down enough for the debt yield pieces so that it actually makes sense for that lender. And so this is why you see a lot more of these pref equity funds coming in. Is it is more expensive than a primary or a large lender coming in and putting in 50 to 70% of the capital stack. But it's something that these operators need, because what's happening, and this is kind of the unique piece of this, is right now refinance is usually not in the picture because it costs too much. It costs too much and to have to bring additional capital to the table to do that. And the second piece is a lot of these offerings that were put together over the last 2 to 3 to 5 years were put together with floating rate bridge debt. And so right now what they have done in the past to mitigate that risk of that floating rate is they've purchased these interest rate caps, right? And these are basically an insurance policy, if you will, for the operator to mitigate the risk of a rate going, say, if a lot of these, when they bought them, they were at like 3%, right? 3.5%, maybe 4%. Well, they would buy an insurance, quote unquote, policy, what we would call an interest rate cap on that loan, which would say, hey, if this won't go, if this can't go any higher than 5% or 6% or 6.5% or whatever that top number is. And if it goes above that number, the insurance policy, the interest rate cap provider, will pay the difference. And so they have been paying the difference for the last, however many months that the interest rates have been rising, and it's been hitting those caps. And now those interest rate caps, just like an insurance policy on your car expires after 6 months or a year or however long your policy is, these interest rate cap policies expire as well. And normally they're going to be between about 2 to 3 years. There are some groups that only did 1 year. Some of them might do a little bit longer, but I would say the average is probably about 2 years. And so because we're coming up on that kind of 2 year mark, a lot of these interest rate caps are starting to come due. And so in order to replace those interest rate caps, they can cost multiple seven figures to replace those interest rate caps. And it's a function of where the debt terms are right now, how much you want to mitigate the risk on the interest rate. And a lot of times the lenders will require and set those terms that you have to get. And so the operators are stuck by trying to find this additional, could be between, say, $1 to $3 to $4 million to replace that interest rate cap based on the current economics in the world right now. And so they basically, and if they don't replace that interest rate cap, the lender can be very difficult with them because they're not going to hit their particular tests for their loan that are going to be, whether it be a debt yield test or a DSCR test or whatever it may be. And now they're either going to have to pay down the loan balance to get it below a certain threshold, or they're going to have to refinance and bring more capital to the table, or they have to figure out a way to get that, $1 to $3 to $4 million to be able to buy that interest rate cap in order to save their project. If they do not solve that problem, the bank will actually foreclose on that loan and take it back and wipe out all the equity that investors have brought into that project. And that's the biggest fear there. And I know you've seen this too, Robbie, but in 2023, we saw that happen quite a bit. We saw
Mhm.
many, many people that had loans that were coming due and they had the loans that were foreclosed on and weren't able to do this scenario. And I think part of it has to do with poor management. And part of it just has to do with not being able to execute on some of these different options because either the deal that they had was not a very good deal. And so no pref equity provider really wanted to provide pref equity for a junk deal, if you will, just to save it. Because at the end of the day, then nobody wants to put bad money after a bad deal.
Right.
One of the things that we look for at passiveinvesting.com and our alliance fund is we want to find good quality operators that are managing their entire portfolio well, not just this one deal we're going to invest in. We want to look at a holistic approach of their entire portfolio to make sure that they actually are managing their entire portfolio properly and be able to come alongside them and say, hey, you got a great quality asset, you got great quality occupancy, you're managing this asset well, you have a problem with this interest rate cap or maybe some capex items, we can come alongside them and say, hey, let's infuse some capital into this project, buy that interest rate cap, give your property some reserves, and it's a win-win for both parties because that group gets to save that the equity for that from all their investors in that project, and then we get to come alongside them as well and have this nice return for us and our preferred equity investors.
Absolutely. Another option is to have a capital call, right? So the common equity, the LP partners may be asked by the sponsors to put additional money into the deal so that they can keep it afloat. Now, the problem with that obviously is an investor who's already put in money and is probably not getting any returns at the point of this capital call will have to put in even more money and may not see the returns that they want to see. So that is an option. It happens to some investors. They are, I've heard several sponsors pushing for capital calls. But another way to avoid that is to get pref equity. Now it's more expensive equity, as we've been discussing, than potentially the LP partners, but it is an option, so they don't have to have a capital call.
Yeah, no, I think that the capital call is definitely a tool in our belt that we can use, but the people that I know that have actually done capital calls, it has not been as successful for them. And then at the end of the day, they still have to get a preferred equity provider. And I would say that the capital calls are probably more successful when the deal is outperforming the original projections or whatever from a performance perspective. But I mean, I've personally, I have my LP portfolio outside of my passiveinvesting.com portfolio, and I have a little over probably 85 different LP limited partnership positions as a passive investor myself in other groups, including Viking Capital, right?
Yeah.
I'm an investor with your
Thank you for
group.
that.
With one of my deals that I had in 2023, the deal was not performing very well, and they needed to raise money to continue to pay the debt service. Otherwise, they were going to lose it because they couldn't continue to pay the deal. Thankfully, I've only had one of those in my entire portfolio, but they did a capital call to try to raise money to keep the deal afloat. Well, at the end of the day, the deal got lost because they were not able to get enough money in. They were not able to save the project. And now the people who put in more money for the capital call lost even more money because they lost not only the capital call money, but also the original investment, right? And so
Yeah.
now they're out on both sides. And that's the biggest fear for a lot of these investors is I'm not going to be dumb twice, right?
Yeah.
If I put
Right.
money into this project and it's not performing to a point where it can support itself, why would I put dumb money? Why would I put good money after bad money, right?
Right.
And that's really the problem there.
Yeah, absolutely. And the other place I see pref equity money being used is in capex work because and I have an investment that is like this as an LP investor with another sponsor where the project was doing quite well, was cash flowing well, but they realized after several years that the capex costs have gone up. They needed to renovate units to a higher level to be at the place in the market where they needed to be in order to have the best exit. So they use pref equity for that reason. And it decreased, it's a little annoying and burdensome on the LP investors because it takes away from their distributions. But then at the same time, when the sponsor, you trust the sponsor, they're doing their due diligence, they know this is the best thing for the asset itself, they have a good exit strategy in place. You trust them to know that they're doing the best for your investment. All right, awesome, Dan. So that's a bit about the background of what pref equity is and why you'd want to invest in some kind of pref equity partnership. And I know you have a pref equity fund called the Alliance Fund. So can you tell us about this? What is this, and how did you set it up?
Sure. So, we kind of, obviously are in the space, in the market, and, we were looking at our own portfolio, but also looking at a lot of other groups that had reached out to us and were asking for advice on what to do, right? And a lot of it was just geared around these interest rate caps that are having to be replaced and the high cost of those. And so for us, we looked at it and we were like, you know what, this is a great opportunity to start our own pref equity fund that invests alongside these different groups and also could be a potential for our own group, right? Because we do have some projects that, have these interest rate cap challenges, and we can either get outside pref equity or we can do inside pref equity, right? Which is, raising it with our own fund, which we call ours called the Alliance Fund. And so being able to put this together and provide an opportunity for ourselves internally, but also for outside groups to be able to take advantage of this was really the primary reason for it. And, we actually see this as a the reason why when we went through like the iterations of what we're going to call the fund, we thought about calling it the Rescue Fund or the some other types of names, but we were like, you know what, this is more of an alliance type fund. We're coming alongside groups that are good quality groups that we wouldn't mind saying, hey, we're an alliance to them. We're an ally. We want to make sure that we're working together and cohesively to make sure that we can protect not only our investors in our alliance fund, but also your investors in the project as an LP and have a win-win at the same time for both parties.
Yeah. And, as you invest in Viking deals, I invest in passive investing deals. And we spoke about this prior to starting the podcast. And, you have a deal, beautiful asset. I invested in it. I'm happy with it, but it's as you were mentioning, it's at the point where it needs a little bit of infusion to just get it going, get it kickstarted. And the deal partnered with your Alliance Fund. And actually, I can tell you this personally, when I saw that, I was actually very relieved because I knew that the equity that is needed was coming from you. You had enough equity to support that deal itself. If there's any more that was needed, you would have it available. There wasn't going to be any need for a capital call or anything like that. So it's actually, I think, I'm speaking from my perspective as an LP investor here, that I think it's a relief for an LP investor knowing that the ability is there for the sponsor to get assistance this way.
Yeah. And there is one other option that you could do, which is instead of raising pref equity, you could do a note. Like it would be a short-term or a long-term note or loan, right? You could do a member loan, or you could do an outside non-member loan coming in as well. And we actually have but the biggest challenge with the note is you got to figure out how to pay it back, right? So if it's a short-term note or a long-term note, you got to figure out, okay, how am I paying that back? Am I paying it back now, or am I paying it back when we sell? Like, how are we going to be able to pay that back? Are we going to rely on some sort of refinance in the future? There's a lot more questions about that, but I'll give you a scenario of what we just did recently that actually is a good reason to do this. We actually have a hotel that we own, and we were doing some renovations on it. And the company that actually has what we call the flag or the primary brand or name of that hotel, they actually kicked in some money for renovations. But when you're dealing with hotels, the challenge with the renovation kickback from the flag, if you will, or the brand, is that they don't give you that money until you're done with renovations. Well, when we first underwrote the property, we didn't project them to giving us anything. Well, they ended up giving us a little over, almost $2 million, a little under $2 million to kick in for the renovations. And originally the renovations were going to be about 3.5 million. Well, right now they're about 5 to 5.5 million, right? And costs went up. The city required us to do some additional things that we didn't plan for, and there's also some foundation things that we had to fix from this particular property because it was a coastal property. And so, but the nice thing is we ended up raising a $2 million member loan. So it wasn't a capital call; it was a short-term note from our investors in that project, and gave them 10 to 12% depending on how they wanted to get paid, whether out on a monthly basis now or just wait till the end. But we also knew we had a way to pay them back on the other end, right? And so that's another scenario of it's kind of a pref equity piece because debt is always paid back first. It's actually still in that position of right past the debt. It's just more of it's now a debt investor, and you're not diluting your investors that are in the project to be able to bring on the debt from an equity percentage perspective. So there are some other options to look at, but the biggest challenge when it comes to the debt piece of it is a lot of times there's loan covenant issues that you have to work through, and sometimes lenders won't allow the debt piece of it because usually with debt it has to be paid, right? Usually on some sort of regular interval. And when it comes to equity, it's not like you can project you're going to give out 5, 10, 15% cash flow or whatever it may be, but at the end of the day, if the cash flow goes down, you can reduce what you're paying that equity provider, right?
Right.
And there might be some like accruals and things like that would happen, like cumulative preferred returns, things like that. But I wanted to bring that up because there are some other options outside of pref equity funds to be able to bring more capital to a project if it's necessary outside of a capital call as well.
Right. Excellent. Okay, so going back to the pref equity fund, in this case, the Alliance Fund, say investor is interested in investing in it. How do you disseminate information to potential sponsors or clients of the Alliance Fund to garner business?
Yeah. So the nice thing is for us, I'm in the space quite a bit. There's a lot of people that know about us in our group, and a lot of groups, are investing with us at passiveinvesting.com, just like you said for yourself, we invest with your group and you guys invest with us. And, we all have capital that we wanted to have diversified, and we think it's a smart thing to do, which is why we like to do co-webinars like this to introduce our different groups to the different opportunities that are available from other groups that we know, like, and trust. And so my network with those people has produced a lot of people that have this problem that we're looking at right now to be able to place our capital from the Alliance Fund into it. And so they'll come to us. We'll look at the property and the asset and see if on the surface it's something that we would want to put the Alliance Fund money and capital into. And then we usually have a phone call with them or a Zoom meeting with them or something like that to put some more details to the project at hand. And then we also ask for a lot of information. We want T12s, we want rent rolls, we want current year budgets and the actuals compared to the budgets. And then we also want the original pro forma and the original investor OM. And then not only that, we also want to have all of that on their entire portfolio as much as we can, because we're not just investing in this one deal, we're investing in them as a whole. And we want to look at their portfolio and go, okay, is this the only project or maybe a handful of projects that maybe down the line are going to need some help? Or is this a more systemic problem with their entire portfolio and everything is going to crap, right?
Right.
We don't want to be investing with a sponsor that's going down, right? We
Yeah,
want to invest with a sponsor that's a great quality sponsor. They got great quality assets in their entire portfolio, but they need a little help.
absolutely. And part of the podcast, we're also talking about how you can structure this so you can get some GP share of their deal. So can you describe how that works?
Yeah. So when it comes to these projects, like we said, there's a lot of these operators that really have nowhere else to turn, right? And so they are willing to give up some GP percentage in the existing deal that they're having challenges with. And depending on the risk profile of that particular project, we may ask for GP interest in one or possibly multiple deals that are outside of that project to help mitigate some of our risk. So if we put this Alliance Fund money into a deal and we get a percentage of the GP in that deal, well, what happens if that deal goes defunct? Well, we want to protect our investors' capital as much as possible. So we might say, because of the risks that we see in this particular fund, we also want to have a GP percentage stake in these one or two or three projects over here, right?
Right.
And instead of having 15% in one other one, I might ask for 5% in three different projects to mitigate that risk even more.
Right.
And that GP stake is not going to us as the GP and the operator; it's going to the LPs in the Alliance Fund. So it's benefiting all of the investors in the Alliance Fund, not just us as the GP.
Yes, and that's how. And when I was reviewing your packet, I noticed that the IR was quite high, and that's why it's that high because you potentially negotiate some of that GP share, and that just boosts up the total return.
Correct.
Um, and how do the investors get cash flow on this, or is the cash received at the back end?
So it is usually a discussion in the term sheet with the operator as to whether or not there's going to be a payout during the hold. Usually, especially right now with the way the debt service is, there's not a lot of cash flow to distribute. So typically, what'll happen is it'll we're when you look at the materials for the Alliance Fund, it's no cash flow, right?
Yeah.
We're not sitting here saying, "Hey, we're gonna provide you a lot of cash flow right now." The Alliance Fund that we've put together is really designed to have a great, nice pop on the back end where we have this nice exit and equity multiple on the back end. And as deals are being exited and money's coming back into the fund, there will be distributions that'll come out from the fund from that perspective, right? And so
Okay.
it's not like we're going to wait until all of the assets that we invest in are sold. As those assets are sold, that money's coming back in, and that also pumps and juices the IRR overall too.
Got it. Okay. And what kind of fees do you take as the sponsor of the Alliance Fund?
Yeah, so there is a capital placement fee, if you will, and that's a fee that, instead of an acquisition fee, it's very similar, but it's what we would call it a capital placement fee, and that's what is charged. It's usually around 2%. It can be a little bit less, a little bit more, depending on the term sheets that we put together. But that is a fee that is charged in order to place that capital with that syndicator.
I see. And then the syndicator is also responsible for the legal fees of putting it together as well, correct?
Correct. Correct.
Excellent. Um, and we were also discussing previously the future of pref equity funds because, as we discussed earlier, there is a need now because interest rates are going up. A refinance is becoming a situation where you have to do a cash in refi instead of a cash out refi. So there's this need for pref equity, but there could be use of pref equity in new acquisitions. So can you talk about that a little bit?
Yeah, so I think one of the things we had talked about, kind of in the green room, if you will, before we got on the recording here, is that I think it probably into 2024 into 2025, we're going to continue to see some pretty strong numbers in regards to this particular type of interest rate cap issues and maybe some capex. But from an overall project perspective, pref equity has been around for a long, long time, right? It's not that we're just like having an epiphany and coming up with pref equity. We have found that there are more issues that are being presented right now that pref equity can solve, which is why we wanted to jump into it with this particular time in the market. But in the future, there are still opportunities for pref equity providers to be able to invest on the front end of a deal. So if a lender will only bring you up to 70%, or say right now 60-65% sometimes, well, a lot of times you can tee it up with and tie it up with a pref equity provider, and they can close that gap a little bit more, so they can get you some more equity, and they might give you equity up to say 80-85%. Well, now you only have to raise, that 15 to 20% of the capital versus 35 or 40% of the capital, right? So it actually preferred equity is usually cheaper than bringing on investors at the common equity level, because those investors are usually going to ride the rest of the train with you and ride that up to get the equity splits on the back end. And so with preferred equity, usually there is a cap. Not always. Sometimes there's preferred equity where it's like we want up to a certain percentage and we want equity splits. That
Yeah.
might be, 90-10, 10-10, 90-10, 80-20, whatever it may be. Or they might say 50-50, or up to a certain, they have sometimes some really crazy waterfalls with preferred equity. They might say, we want a 50-50 split After we get our first, say 12%, we want 50-50 split until we get to 15%. And then it goes the other way around where they only get 25% and you as the operator or the deal itself gets 75%. And then once it gets over 18%, it changes, splits again, and then 20% it changes again. So they have a lot of times these really crazy waterfalls with the preferred equity that as you are getting more and more profits, they're getting less and less, and you're getting more and more. So it can be a benefit, but that's not usually how the normal common equity occurs. Normally, the common equity is there's going to be a preferred return. There may or may not be a catch up on that preferred return on the GP side. And then there's usually going to be some sort of split, whether it be 70-30, 80-20, until you hit a certain, like maybe one more hurdle. Like for us, it's usually a 13% IRR. And then after that 13 IRR, the rest of it just splits 50-50 between us and the investors. And so it can be a little more complex and complicated with preferred equity. But typically, at the end of the day, it is usually cheaper to do preferred equity than it is to bring in the more common equity, if you will. Now, there are also some more caveats to the preferred equity that you would not have with common equity, and we can kind of go through some of those if you want to. But there is definitely some pros and cons on both sides of using pref equity, and then of course not using pref equity.
Yeah, and as we discussed in the beginning, you are more assured of your returns as a pref partner, but your returns are less than common equity. So if you know the deal's gonna, you as a sponsor, the deal's gonna blow up, and you're very confident in your projections, then getting that pref piece makes a lot of sense because that's less expensive.
Yep.
And we've done that with institutions too. This is pref, as you mentioned, it's out there. It's sort of like become a topic of conversation right now because groups like you guys are putting this package together for retail investors, but institutional investors do this all the time, and we've partnered with them as well. I'm sure you have as well. Well, Dan, this was an amazing discussion. I really appreciate your insights. Anything else that you want to share with our investors before we conclude?
Well, I mean, we did just have a book released recently. So in the latter half of 2023, we just launched our book that was written by our partners. I actually have it on my shelf, if you can see on the video here, right there. It's actually called Apartment Syndication: The Ultimate Guide for the Passive or Active Investor. And you can find it on Amazon. I did the Audible version of the book, which was pretty cool to do in one of the studios that we went out to here locally. We have an Audible version of it. We got an actual Kindle version, the ebook version, and of course we have the printed version of it as well. And you can grab that on Amazon. The whole purpose of that book was to really kind of, for an active or a passive investor, to teach them a lot of the nuances as to what we do in the business and not hold anything back. But also, a lot of these gurus will teach you about how easy it is to do apartment syndication, and it's really not easy at all. It's not necessarily hard, but what makes it more challenging is there's a lot of moving parts and a lot of different components of it. You got a lot of plates that you have to spin at the same time, and it teaches you all those different pieces of it. So whether you want to do it or whether you don't want to do it as an active investor, I believe as a passive investor, it's great for you to be able to have the knowledge and the underlying base of what these different pieces do so that you can spot a good operator versus a bad operator. And even in that book, we talk about the 8 red flags for passive real estate investing and what to watch out for, what to look out for, and things like that. But obviously, if you want to follow me on LinkedIn, you can do that as well. You can just go to linkwithdan.com, and that'll bring you straight over to my LinkedIn profile. Connect with me there. I like to produce a lot of content and kind of put it out there as well. So I really do appreciate you having me on. I always love talking about these different types of topics, and look forward to doing it some more in the future.
Absolutely. Happy to have you, Dan. Thank you.
Thanks.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.